Hi, I'm Ilana Weinstein, CEO of the IDW Group, a search firm I founded 13 years ago to focus on the hedge fund world. When we think about hedge funds, we often think many players and an industry that's proliferated quickly. What might be surprising, though, is just how concentrated this industry is, given it's still quite young. If we can put this slide up on hedge fund assets. Do we have that? Okay. No? Yes? Okay, perfect. There, I see it. Excellent. Okay. So hedge fund assets grew 31% in just the last 2 years. They've grown, it's not up there, but 67% since the crisis. Of the almost 5,000 actively managed hedge funds tracked by Preqin, only 11% manage 92% of the assets in this industry. We all know about the 80-20 rule. This is the 90-10 rule. 11% manage 2.8 of the $3 trillion. With us today, we have 3 players who fit squarely within that 11%, albeit at different points of evolution, and one who helps drive who gets to be there. Ken Griffin, hedge fund titan extraordinaire. Ken founded Citadel practically out of his dorm room at Harvard 25 years ago and built it to be one of the largest, most successful, and sophisticated hedge funds in the world. Jason Karp, to my immediate left, founded Tourbillon just 2.5 years ago, and at $2.5 billion, that means Jason has beaten the odds as an emerging manager, because what that slide also shows is how difficult it is for newer managers to scale. Alex Klaban founded $10 billion Senator in, of all years, 2008. Alex clearly likes a challenge, and was seeded by Gideon Berger. Gideon is the chair of the investment committee of Blackstone's alternative asset management effort, which is Blackstone's seeding, allocation, direct investing, and stakes business, and it's $70 billion. That makes Gideon and Blackstone the biggest client of the hedge fund world. So welcome, everybody. And Jason, I'm going to start with you, because you are the unwitting author of the title of this panel. Jason and I met a few months ago, and you said to me, hedge fund managers focus on products, and they focus on returns. Shouldn't people be an asset class? And I said, absolutely. And what's more, that's a great title for a Milken panel. So here we are. What did you mean by that?
I think what I meant by it was that, in our industry, people spend more time on stocks than they do on people. And with stocks, you can sell them. You can get out of them. With people, it's a bit more complicated. And in my 17 years of doing this, what I've discovered is that people, if you train them properly, if you invest in them properly, have more duration, more yield, and more optionality than any stock I've ever purchased. And I find it ironic that most of the people in our industry spend so much time studying companies and spending so much time on individual investments looking for asymmetry, looking for upside, downside asymmetry, and looking for great risk rewards. And yet there isn't enough focus on how much reward you can actually reap, not only in our industry, but in every other industry, from investing in people.
So I'm assuming that's a differentiating philosophy that led, in part, to Tourbillon's ability to scale as quickly as it did, not mention performance. It goes without saying that you can't get and stay in that 11% without outperforming your peers over time. But it's also true that time and again, we have founders who come into our office who've been out there for 4, 5, 6 years and have a great track record and just get stuck at a couple $100 million and can't grow. Ken, what do you see as the key variables outside of performance that lead to a hedge fund's ability to become an institution and be a magnet for capital?
So I think there's a nuance to the way you phrased the question. You spoke about the manager who comes to visit you who's stuck at a few $100 million and they can't grow. That's actually not atypical, because many managers don't aspire to run a complex organization. They're incredibly focused on the joy and passion that they have in investing directly in companies, whether it's a equity fund or a fixed income fund. They simply aren't interested in having a complex organization with dozens or hundreds of people. And so what you might think of as being stock, they think of as being a very healthy, great business for them that meets their personal aspirations. I think that the more interesting question is, why are some managers focused on building larger platforms and having a variety of teams around them, such as we do at Citadel? I think that speaks to some managers, such as myself, who really do enjoy the art of investing, but frankly take great pleasure and satisfaction in building a business. And building business means that you have to think about issues like attracting, developing, and retaining great, talented professionals.
Gideon, part of your oversight is finding new managers to seed. Sorry, you're over there. And you, Alex, and his co-founder, Doug, were analysts at York when you gave them their seed capital. These guys don't have a discernible track record. They have never built a business. What did you see in Alex and Doug that led to that seed, and what do you think are the elements that allowed them to get to 10 billion when so many others aren't able to get to that point?
Well, I would say a few things. First of all, we don't have a crystal ball. I mean, Alex and Doug are examples of great success. They don't all work out that way. And in fact, I don't think, Alex, you even know this, but when you and Doug first came into our offices, through that whole due diligence process, you were referred to as the kids. So we don't know, but there are certainly some things that we look for, and Alex and Doug had them. And I actually think Ken kind of made the point, which is, why are they doing this? What people don't appreciate is what it takes to build these businesses. And so what are you trying to build, and why are you trying to build it? I think that a lot of people refer to things like talent, or are out there trying to distill talent. And I think the word talent is a substantially overused word, in that what it really is about hard work. And some people are trying to become lifestyle hedge fund managers, and some people are just trying to get rich, and some people actually love investing. And whether you love investing because you love picking stocks and want to do it on a scale of $200 million, or whether you love the challenge of trying to build a big organization, what are you actually trying to do, and why are you trying to do it? And then the other thing, frankly, is character. It's easy to find people who have been successful. It's easy to find people who have put up good track records. It's harder to find people that have successfully navigated adversity and continued down the path that they set out for themselves. So the two things I would that we focus on the most is, one, just the commitment to building this organization, a real determination to do it, and a character that suggests that we think they can withstand adversity. There are a whole bunch of table stakes in terms of basic capabilities, but frankly, there are a lot of people who went to Harvard Business School and Wharton that have those.
Not Harvard Business School.
Sorry, not Harvard.
But this whole thing of what makes a great investor, I'd love your thoughts on, Alex, as to how to tease that out, because there are plenty of people, very smart people, who are attracted to this industry. We have guys who come into our office who have great analytical skills, they have great process, they have the science part down right, but the returns are middling. And I'm curious, aside from those obvious things, what are some of the magic ingredients that do lead to being one of the greats?
Sure. There are a lot of things, but to distill it down, in my view, good investors make analogies. They don't just make investments. We use analogies a lot for two reasons. One, we use them in our process to help us identify patterns and anomalies to help generate ideas. And we also use analogies in terms of communicating how we invest to our clients. And I'll give you an example of the power of an analogy. If I told you that an acre of land was 43,560 square feet, you might forget that tomorrow. Some of you may have already forgotten that. If I told you that an acre of land was approximately the size of a football field with the end zones cut off, you might never forget that. And so great investors, in my view, are able to distill complicated ideas, complicated situations down to the one or two things that really matter, and then make an analogy in their head to distill sort of what the core of the investment is.
Do you think there's an art part to this that can be articulated? to being a great investor? Because you're one of the greats.
So I appreciate the compliment. And so it sets me up for sort of a tough question here. So we're in a lot of different businesses. And in every one of our businesses, there's a science and there's an art. And the science is usually in sort of encapsulating the process and the hard work that goes behind driving an investment decision. And we'll do thousands of management meetings a year. There's just a lot of time in conference rooms, airports, and hotels. It's as unglamorous as it can be. But you use that to assimilate information about how a company's progressing, how the business is unfolding or developing. And if you're really good, you have a perspective on how earnings are playing out, what guidance might look like. You have an idea of what the quarter is going to look like. But at the end of the day, the art comes down to not how well you can do all that work, but how well you can differentiate your idea from what other people perceive the reality to be. And you're successful in this business when you have a differentiated point of view and the market agrees with you when the information that you have becomes known by all. And that is really the art in this business. It's understanding how the market is going to incorporate the information that you have that others don't have. One of the common mistakes that people make when they're very young is they go, geez, this company's going to blow out earnings. Look, the street says they're going to earn 52 cents. My research says 55 cents. The company announces 55 cents, the stock goes down. It's because you're not aware that the other sophisticated investors have all done the same work that you've done, and they actually think earnings might be 56 or 57 cents. It's a disappointment. So you need to take a step back from all the hard work, all the spreadsheets, all the modeling, all the time in the conference rooms, and have the ability to understand how will other investors respond to this information when it becomes known. That's the art in the business. It's a tough art.
Gideon, when a fund is having, you allocate to plenty of funds. When a fund is having difficult performance, what keeps you from redeeming? What are the things that you need to see?
Well, I actually think it's no different from when a fund's having great performance. I mean, the lawyers make you put it on the bottom of every pitch book. Past performance is not an indication of future returns. We generally think that's true. And there are a lot of things, and it depends on the specific strategy, et cetera, but there are a lot of things that go into performance that are very independent of talent. And so what we try very hard to do when we make investments is actually be very explicit and write down our investment thesis going in. Why are we making this investment? Where do we think the edge or the opportunity comes from, whether it's a top-down view of the environment or a bottom-up view of the way this person or group of people is going to make money. And so you fast forward a year and you're hopefully reflecting a lot less on performance than you are on how has this thesis played out. And if the thesis is playing out but the investment isn't working out, that's actually potentially an opportunity to add money. And if the thesis isn't playing out but you're making money, well, that's called good luck, which is probably better than bad luck, but it's not a real repeatable investment strategy, and that would hopefully cause a redemption. So I think trying to separate why you're making an investment from the outcome, although of course over some period of time we're all investing for outcomes, but over any shorter period of time, separating why you're making an investment from results is very important in order to have a discipline around where you're putting your money. Otherwise, it turns into an activity of return chasing, which quite clearly doesn't work.
I want to go deeper in terms of the unique challenges of managing the kind of people the hedge fund world attracts. And I'm reminded of a conversation I had with a client not too long ago who runs a large multi-strategy fund who said, I'm bringing in an NBA head coach to talk to myself and my partners about how to motivate and get the most out of our people. And there was silence on my end because I was really hoping he had said MBA, which I know infinitely more about, and not NBA. But luckily he continued and said, this has nothing to do with basketball and everything to do with psychology, discipline, and organization. And he went on to describe the three analogs as he saw them. One, an NBA head coach has to manage 20 and 30-something-year-olds who are wealthy enough to choose not to play. 2, each player was a college All-American and captain of his college team, and now has to work at the NBA level as a cohesive team. And 3, the next season, all teams start with a 0-0 record, and the coach has to come up with a new bag of tricks to keep it fresh. What do you guys do to attract, retain, and keep it fresh for the people who get the best seats in our industry?
Sure. So I'll start. So, culture is really important because we manage a people business, and your assets obviously proverbially go down the elevator, every day. In my view, culture is a combination of the values that are important to your firm and the rituals that you use to reinforce those values. The values that we have as a firm are based on the fact that we're inwardly collaborative, we're outwardly competitive. We all, we really value hard work and humility. The rituals are the daily tools that we use to sort of reinforce that kind of behavior. These are, just to sort of take it up a level from hedge fund life, there are rituals to build strong cultures in all aspects of life: religious life, family life, athletic life, as you described. I'm thinking of a couple of stories from the great basketball coach of Carolina, Dean Smith, who had a really neat approach to building a strong culture at Carolina, the Carolina Way. And he did 2 things that I thought were really awesome. One was to emphasize process, that process matters more than outcomes. He would break his squad up into 2 teams and have them scrimmage against each other. And he wouldn't keep track of points. For players who scored a basket, that's not what determined points. What determined points for Dean Smith was, did you take high probability shots or low probability shots? So if you're a player that took a 3-point shot off balance with somebody's hand in your face, even if you scored the basket, he wouldn't count it. But if you passed the ball to a player who had an open lane and made a layup, he'd count that because that was a high probability shot. He'd award points for blocking, for assists, et cetera. And so he really wanted to emphasize to his players that process matters, and that's what wins games. The other thing he did was he created a rule called the point to the passer rule, where every player that scored a basket would have to point to the player that gave him an assist. And that simple gesture was a really strong statement about togetherness, about heart, about teamwork, about humility, selflessness, et cetera. So for me, creating a great culture is all about the values you believe in and the rituals that you use to reinforce those values.
I mean, I'm out of my depth on that basketball here, but it does sound like he also created a culture where it was okay not to get the shot, right?
Exactly.
And so,
Yep.
And that's interesting in our business, which is very bottom line oriented and very performance oriented. So
Yeah, so the best investors get things right only about 60% of the time if you're running a diversified portfolio, which means you're making mistakes 40% of the time. So there are some, heads of hedge fund organizations that get really angry at their analysts for making mistakes, and then there's others that sort of view it as the natural part of learning and really trying to make sure that those who do make mistakes, keep their mistakes small and always use it as a learning experience. And then once you've learned the lesson, you forget it and you move on and you sort of get on with life. And so, so we recognize that.
Jason, what are some of the attributes that might not be so obvious of your most successful hires? And what are some of the unexpected red flags that you've learned to watch out for over time?
Yeah, no, that's a great question. So I've had the luxury, I was at 3 firms before I started my own firm, and I had several managerial positions where I either interviewed, managed, or indirectly managed hundreds of people. And there were a lot of things that I learned that were counterintuitive about people, particularly in this business. And one of the things that we've done to get around that sort of counterintuitive notion is at our firm, and I actually learned this at a firm 2 firms ago, we actually administer a 3-step personality exam that's conducted by a former CIA interrogator. And the spirit of it is...
Who's a woman?
Who's a woman. She points it out.
Mm-hmm.
and they're very effective at pulling out things.
Let's just let that go.
She told me I had to make it fun. One of the things that we screen for, and it shows up on all of the analysts that we've hired, all of our professionals that we've hired, is a variable called openness to change. And it's the single most important variable that we screen for. And what openness to change is it's basically how well you're able to quickly change your mind when you're presented with conflicting information. And I found that combined with a variable that's in psychology is called grit. In our business, we call it resilience. Those are the two factors that I search for most. And so, counterintuitively, I actually like to find people who've had a spectacular failure in their life and gotten through it. Some managers will view someone who've had, and it doesn't have to be in business, some people will view that someone who's had a spectacular failure in their life as a sign of a problem. And I think the challenge for us as managers is to recognize, did they learn from that failure, or is it symptomatic of a deeper issue? And what I have found is some of my most successful hires and some of my most successful people that work with me and really help our organization are people who've had severe adversity in their life, gotten through it, remain open to change. And ironically, the worst hire, so we generally bucket hires into three categories. We have excellent candidate, we have dangerous candidate, and we have nuisance candidate. And excellent candidate are the candidates that have some of these variables. They're very open to change. They're very resilient. They've done a lot of diverse activities in their life that show they're overachievers and they like to win despite the odds. The dangerous hires are the ones that are actually, I learned a long time ago how to avoid them, but I made the mistake a few times the hard way. The dangerous hires are typically the most brilliant people. The dangerous hires are the ones who are so brilliant they think that everything they believe is correct. They think there's no way they're wrong. When they're presented with conflicting information, they don't change their mind. They're actually impervious to pain, and so they're reckless. Sometimes they're reckless in their social life, and in our business, you're not supposed to connect social life with business life, but I find that to be irresponsible not to look at both, because someone who's reckless in their personal life, it's highly unlikely that they're not reckless in their business life. And a nuisance hire, which is where I erred the most in some of my early hiring, the nuisance hire, because I tend to like to hire neurotic people. I'm neurotic, and I like to find people who are, we have several forensic accountants, we have several people who are very high on attention to detail. Details are extremely important in the investment business, but what we found is that sometimes when you hire someone that's too neurotic, all they are is a drag. They're toxic. They constantly complain about everything not being their fault. Everything is the fault of somebody else. Everything goes the wrong way. And I'm sure everyone in this audience has hired a nuisance hire. And it's just it's a nice way to sort of describe it. But we found that having a systematic way to identify people before they come in to be really helpful. And then additionally, it's really helpful on how to manage them. So once you know their personality profile, and if you assess it correctly, you actually manage them differently. So some people are push, some people are pull, some people actually respond better to criticism, and some people respond better to a carrot. And so it's been enormously helpful to us in how we've cultivated talent, how we've grown talent, and I manage pretty much everyone on our team differently than the next.
When you have a nuisance or dangerous, is that the term you used, hire?
Yeah.
Dangerous is obvious. Let's talk about the nuisance hire. How quickly do you push the eject button to get rid of that person?
I've gotten better at it. It's difficult. I mean, deciding that something is not working or it's over is a very difficult thing. And one of my, when I took the personality tests, one of my good and bad traits that at the same time was I'm very high in empathy. And what that means is that I typically can work with different individuals on how to make them better, but it's very difficult for me to decide this is done, it's over. The nuisance hire is challenging because It's a drag on your resources. It's a drag on your energy. But they can be valuable. And I think, to me, it's really a risk-reward trade-off of are they affecting or infecting the other people in the organization? And if they are, it's a pretty cut and dry thing for me. Whereas sometimes they just need to be coached. And I think, what Alex said was dead on, that a lot of this is really coaching. I mean, these are hyper-competitive people. Many of them were valedictorians of their respective high school or college. And a lot of them just need coaching. And I think the surprising thing for me over the years is how much real coaching has helped. Not just hey, get back up and do this again, but really working with people on their deficiencies. And I've had many mentors in my career, and they helped me tremendously. And I think it's a totally underrated aspect of our industry is how important management really can be.
Ken, what's the most surprising thing you've learned about people from managing people?
Oh, we don't have enough time today.
Yes, we do.
No, we don't. Well, let's see. We had an individual who had nuclear weapons clearance for the U.S. government who tried to, let's say, take some source code once. So it goes to prove that no matter how good the CIA is or the U.S. government is at determining who should have nuclear weapons clearance, can't always trust that person. That was quite surprising. Look, I think taking a step back to 100,000 feet. And thinking about some of the comments that were just made, some of the most important lessons that I've been shown on the topic of human capital that have been touched on here. Number one is coach your stars. Your team members who are fair, as you would put it, your nuisance category, don't waste your time. Let them think or sink or swim. Coach your stars. If I can get 10% more out of my best colleague, that makes a huge difference to the success of Citadel. But if I can get 10% more out of somebody who's in my bottom decile, it doesn't move the needle. So one of the most important things that I've learned in my years of managing people is I spend the vast majority of my time with the individuals on my team who really have the highest potential. And in some sense, everybody in the bottom half, let them sink or swim on their own merits. I'm not saying to be a lack of empathy or a lack of caring about them, but in running a business and being entrusted by our shareholders to maximize the return on their investment, my time is best served, and my senior leadership's time is best served by really trying to get the 10 or 20% more out of the top decile of our team. That's one of the really big takeaways that I had in my career, and I had it about 15 years ago from a coach that worked with me, who had coached some of the senior leadership team at Goldman Sachs. So we are a big fan of coaching, but we're really thoughtful about where we put that resource. We put it against the very best and brightest in our organization that have the greatest long-term potential. The second reality is the reality that we are going to have turnover. And we can't live in denial. We just need to accept it, and we need to embrace it. Much of our business, success comes from being not good at what you do, but being extraordinarily good at what you do in a very narrow range of activities. You could be a healthcare analyst at Citadel, and then a healthcare portfolio manager. And you are so incredibly good because you understand the biotechnology, the products that you invest in. You know the management team's cold. You've read the 10K for Amgen 20 times in your career. The problem is when really, really, really smart people do the same thing for 20 years, they burn out. And there's no ifs, ands, or buts about it. What makes them so good is they're so smart, but what makes them burn out is they get bored. And so one of the things that I need to think about and that we address at Citadel Continual is we have people that have long careers with us, but we have to deal with the reality that either they need to take on new challenges that reignite their passion for what they do, or we need to have the mature conversation. It's time to do something else in life.
It's so key, but it's not something that, I think as organizations get bigger and it gets more crowded at the top, it is challenging for a manager to figure out how to give somebody that new challenge. We had someone come into our office recently who who's a portfolio manager at a very large, successful fund who had always managed his sector, and he'd done phenomenally well. And he actually was one of the best PMs at this fund. And despite the fact that he had great track record, managed a lot of capital, and was paid, even by our industry standards, exceptionally well, he said, I have no more white space left to hunt and kill. There is someone above me, and I want to build a bigger, broader business. And so it is difficult, and for I think a larger fund to figure out how to do that. How do you do that? How do you implement what you're saying?
So I got to tell you, that sounds like a failure at the top. I mean, somebody comes to my office and says, there's just nowhere to grow at Citadel. I just scratch my head, okay? We are a $25 billion asset manager in an industry with $3 trillion of AUM. That's a 1% market share. In most parts of our economy, a player with a 1% market share, would you use the word irrelevant for that player in most of your portfolio? Right? The question I've asked my colleagues around the world, we do this in terms of importance of market share. Who's the 5th largest maker of personal computers in the world? And who cares? All right? So we're in an industry where we, as one of the larger firms, with a 1 share, we have significant room to grow. And if you're coming to my office and you say, we don't have any white space for growth, I think you're out of your mind. I think the real issue here is that the portfolio manager who's so good at healthcare, who wants to go on to do something different, is objectively looking at a material step back in their career. It's hard to shift from A to B. I've seen it done. The person who runs our global energy business ran the credit correlation business at Deutsche Bank in the 2000s. He built it from scratch. He built it to being the market-leading firm in credit correlation. And I tried to recruit him to Citadel back in roughly 2005, 2006. He said, Ken, like, really interesting, but to be clear, I already built the preeminent shop in the world. Now, if you had something new, give me a call. I'd be really interested in that. And in 2007, I called him up and said, how about something like completely different from what you do today? I want you to trade oil, natural gas, and power. He's like, are you kidding me? I said, no, you're one of the brightest guys I've ever sat across the table from. I think you would be great at running this business for us. And you said if I had something new, you'd be open to it. In 25 years, I'll see a handful of people that have both the talent and the audacity to take on that new challenge. And he's been incredibly successful with it. But that's a very rare person who at the pinnacle of their career, it's like being Michael Jordan.
And playing baseball.
And playing baseball.
That was not rehearsed.
Gideon, how do you assess turnover from the outside looking in? Good turnover from bad turnover?
Turnover is good. A lot of it gets talked about as if it's something to be avoided. It's healthy because it creates white space, and it's healthy because we make mistakes in hiring, and it's healthy because people do burn out. I mean, I think there's something wrong. In the same way that I think tenure is bad, I think turnover is good.
My business wouldn't exist if we didn't
You
have
definitely think turnover is good. Look, when you're making an investment in a hedge fund, there are obviously a certain set of people that are core to the hedge fund and your underwriting of that hedge fund and the thesis. And if there's substantial turnover among them, no question that that's problematic. But a healthy level of turnover within a hedge fund is a natural evolution and something we would hope to see, not only expect to see. But I've heard a lot about the cultural aspects, and it's interesting. We look at a lot of hedge funds, and I think you hear little bits from these 3 hedge fund managers. People run different cultures, and there's not a right answer to this. I mean, Alex and Doug have successfully built a culture that's very much about collaboration. Frankly, it's really easy for the founders to say, let's all collaborate. It's their business. That's what they would love everyone to do. Sometimes that's harder to make happen. Other businesses don't even really aspire to that. I do think that there's a reality, though, that when it comes to talent and talent mentoring and talent development, that problems never go away, and you rarely fix problems. I think you can develop talent. I think some people mistakenly treat people like commodities. They will be the same in a year as they were a year ago, and I think talent can be developed, but we rarely see situations where problems get fixed, and dedicating a lot of time and energy as a founder, as a senior member of a hedge fund organization to try and fix problems is not usually a good use of time, and the people who get rid of those as quickly as possible maybe have lower scores on some of the more softer elements of the personality test. We find generally do better.
You've built, you said earlier, Ken, that not everybody aspires to build a big organization, as you have. But for those that do, and I would argue even those that run smaller organizations and leaner investing teams, these are all lessons of management that we're talking about. And you still want the very best people at your fund, and from where I sit, there aren't many people that I would throw a lasso around and call the very best. So it's not that easy to attract them, retain them, cultivate them, all the things we're talking about. And you don't get a lot of management experience in this industry. People become senior relatively young. Investing teams are lean. You started Citadel basically a year out of Harvard. How did you build this organization on the go when you had there was no blueprint, there was no beta testing that you did? You just did it. How did you do that?
So, history is written by the winners, and if you look at the history book of Citadel, the 20 chapters where we got it dead wrong, we've edited out. They're gone. And it was a lot of editing over the years. I would say objectively, there were two things that were pivotal in my career early on. In fact, three that really define what Citadel is today. The first was the advice that I had from Frank Meyer, who hired me out of Harvard to manage money for Glenwood Partners. And I had a single strategy, convertible bond arbitrage, and Frank was quite supportive of this. But Frank said, look, in life, you don't want your life to revolve around a single strategy. You want your life to revolve around building a platform that will attract the best and brightest across a variety of strategies. So that initial vote of confidence from my first investor, my first mentor, was really important for me setting my aspirations much higher earlier in life. The second two events that are important in sort of understanding how I think about the business. The first is that we spoke about cultures of firms. Citadel is a culture of learning. There's a couple of key words that come to mind when I think about Citadel's culture. Teamwork. Frankly, you can't succeed today in the markets unless you're part of a great team. The days of a single person, a Bloomberg, I'm going to have an idea and I'm going to win, those days are history. The team is the essence of how you win today. The second part of our culture that defines why we win is we're a culture of learning. And I've always been just happiest surrounded by really bright people from whom I learn and who teach one another. And I think one of the biggest reasons that people come to Citadel and stay at Citadel is that the immense rate of learning that takes place within our four walls every single day. This is so important to what makes Citadel tick. There's just a huge amount of just professional satisfaction in knowing that I've learned something today, and I've learned a lot this week and this month and this year, and over the course of 5 or 7 years, I'm way ahead of where I would have been in 90-some% of my alternative career choices. And the third part of our culture, of why we win, is it's words from Abraham Lincoln. I find it remarkable I quote a president's words as to why we win, but Lincoln had a great quote. Things may come to those who wait, but only those things left by those who hustle. And we hustle. Like there is a real forward-leaning ethos within our firm. What do we need to do right here, right now to get ahead of the next guy? So if you're at a conference and you hear the management team say something, you're on your iPhone with our mobile trading app. You're buying and selling the stock right then and there. Or if Amaret's in trouble, we're the guys that put 2 guys in the ground at Amaret's headquarters to go through their financial records to get a deal done in 36 hours to trade $30 billion of positions. We're the only people with people on the ground at that moment in time. Like, how can that be? Or when you're buying Sowood's portfolio, the gentleman from Morgan Stanley Knight called me up. He goes, look, nothing's going to happen tonight. I'm sending my team home. I'm at my house in Greenwich. If you need me, give me a call. And I'm like, we're going to trade this book tonight. So if you're our partner, you better be there. And if you're not, we'll talk to you in the morning. And he laughs. He chuckles. He goes, good luck. And at 6 a.m., we bought that $20-some billion portfolio. And at 6:30, the team from Morgan Stanley is screaming at us as to why we're not their partner. Well, you guys had a good night's sleep, and we just made a bunch of money. Thank you very much. So there's a real ethos at Citadel of leaning forward in how we do business. All right, so the culture issue is really important, and we think about that very much. So going back to the initial question, Frank Meyer, build a platform. Number two, my own desire to be part of a learning organization. Like, that is what wakes me up every day, excited to go to work, is I'm going to learn something. And everybody at my firm really shares that passion for learning. The third is the fortuitous fact that I decided that I would trade US convertible bonds and Japanese equity warrants when I was like 21 years old. Now, there's a cool thing about this when you're 21 is you can actually stay awake for 16 hours at work. All right? And then when we decided to add Europe into the mix, you realize you can't be awake for 24, which meant I had to learn to delegate when I was very young. And that willingness to trust others in their judgments and decisions at such a young age was really pivotal to my career, because it allowed us to build what Citadel is today, which is a partnership of incredibly talented individuals who collaborate, who work as a team, who know how to trust and interact with one another as peers and as colleagues. And that's been a really important part of our success story, is that ability to delegate and to work with somebody myself who really, at a very young age, had to learn to delegate. And one of the parts that you learn in delegating, and I'll share this, and then I'll let everyone else have more airtime, and I apologize. Like, every one of my young colleagues, keep some of your work product. Keep some of your write-ups. Keep some of the things that you think are well done. 10 years later, go look at the same work. You're going to go, I can't believe it was that poor. Right? If you go forward 10 years, go home, take something out that you did 10 years ago that you were really proud of. In most cases, you're like, I would do that so much better today. Now, the point of this is that when one realizes that they are anything but perfect, it allows them to be much more receptive to dealing with other people's judgment calls and decisions. You know, we pick stocks often. There's 20 things you might want to know, but there's only 10 you can actually get a handle on. You got to make decisions under uncertainty. And as you said, your guys are right 60% of the time. I wish I had your guys. We're like 52-48, all right? Like, if we were brain surgeons, we'd be in real trouble. But go back and gather the information that you use to make decisions. And I'm not telling you not to be forgiving of people around you that make the decisions that are wrong, but realize that we're in a business where that art and science, your best guys are 52-48, 53-47. I have no one who's 60-40 in any of our core equity trading businesses. That person would be like, that'd be a god. So thank you. I apologize for taking so much airtime.
No, you talk about building early on, Ken, having decided to build a multi-strategy, multi-manager. And the other construct, of course, is what I call the key man fund. So centralized structure around each of you two as key men, being the founders who have ultimate trigger pulling responsibility. Do you think there's greater vulnerability as people evolve, because this is a very entrepreneurial industry. People come into my office, the ultimate, after being an analyst, the next step is to either be a PM or plant a flag and become a hedge fund manager. Within a multi-manager construct, they can manage capital and make decisions, have trigger pulling authority to make decisions. As senior as they get, and as much as they partner with you, it's still your show. So how do you balance that in terms of retaining your best people as they mature and arguably become even more effective for you?
I'll let him start because my answer is controversial.
Sure. So we've cultivated great people. Many of my partners could probably launch their own fund on their own and be very successful. At the end of the day, I really feel it's important to give people responsibility, opportunity, and autonomy if they've earned it. And again, to make them feel like they're doing important work that matters. I think Ken talks about this stuff as if it's, he talks very calmly and it's as if it just sort of happened and it was easy. The reality is in the beginning it's really hard. And so, I think that giving, a collection of individuals a sense of purpose is really important. It's not what you do or how you do it, it's why you do it. Martin Luther King, one of the great cultural leaders of our country, stood before a crowd of people 50 years ago and said, "I have a dream." I have a dream, he said, not I have a plan. And so, I really feel it's important to really focus on sort of why we're doing what we're doing together, why we're doing important work that matters, and again, giving people responsibility, opportunity, and autonomy.
But just to play devil's advocate, you were part of a team, and you and Doug chose, let's say, arguably a cohesive team with a great culture, to plant your own flag and start Senator. Was there anything that you could have done to keep
for me,
you?
Yeah, truthfully, it was a personal, I'll speak for myself, not my partner, but for me, it was a really personal decision. I just wanted to put my own dent in the universe. I guess I thought of life as an option, and not to sound too dorky, but what determines the value of an option is time and volatility. And I wanted more volatility. I wanted to feel in a deeper way the successes and the failures of what it meant to be an entrepreneur. And so that's why I went off on my own.
But is there something about, if you had been a portfolio manager?
Wait, just to interject for a second, that's rare. Very few people say they want more volatility in their life. And I think that's one of the important things to remember. Why do people stay part of a team? They enjoy being part of that strong entity. And people's inherent risk aversion often leads them not to want to leave that environment to go out on their own. That's a very rare trait in people, to find that willingness. I'm going to take on more risk in my life.
But isn't that the ultimate
But
arbiter?
entrepreneurs typically have that.
Yeah.
That's why entrepreneurs leave something good and safe and do something that's risky and unknown.
Entrepreneurs have a special quality. The special talent that they have when you're starting out, because I remember when and I'm sure this is true for you too, but when you start out, it's lonely, it's dark. There are not a lot of people that want to believe in you. And the key attribute that I find just in my own learnings and reading about great leaders, great entrepreneurs, is that they have this special talent, and that talent is to make people believe what they believe. Too many managers, I think, talk about the what and the how and not the why. What's our purpose? What's our value? What's our cause? What's our belief? If you look at, there's an interesting book that I'd recommend to others called Start With Why, written by a fellow named Simon Sinek, and in it he talks about Dell and Apple and what made Apple so great. Why do we all buy Apple's products? And he came up with this idea of this golden circle. What is the concentric circle on the outside? How is the one in the middle? And why is at the center? Too many companies, too many managers start with what. They talk about what they do. All organizations know what they do. Some organizations can talk about how they do it. What is their proprietary process? What's their intellectual, what's their IP? And not enough talk about why they do it. Dell Computer. Hi, we're Dell Computer. We make really powerful computers. We have a sophisticated process for making them. It allows you to incorporate your own options into the computer, and after you order it, 2 days later, you'll have it. It's not such a compelling pitch. When they started with why, what, what, how, and why. If you compare that to Apple, part of Steve Jobs' genius was he sold from the inside out, not the outside in. Too many of us sell from the outside in, not the inside out. And so Apple Computer, if you remember their Think Different campaign, was all about, if you're one of the crazy ones, if you're a misfit, a rebel, if you think you can change the world, if you believe what we believe, then try one of our products.
Great campaign.
We make computers.
It's immense.
And what that allowed them to do, just to make one final point, back to what Ken was saying, he runs a very complicated business across a lot of different strategies. When you communicate why you're doing something, it gives you more flexibility to do different things. Dell Computer, when they came out with an MP3 player, nobody bought it. When Gateway Computer came out with a flat screen TV, nobody bought it. Apple is given the license to innovate because everything they do challenges the status quo. Whether it's a computer, an iPod, an iPad. None of us knew that we had a reason to use an iPad, Apple Pay, Apple Watch, et cetera. And so communicating why you're doing something to your team and to clients, I think, is the most important thing you can do.
I mean, I think what he's saying is enormously important because for people who start up, including myself, you know, literally every single person that joined me at our launch took a sizable demotion. And a big part of why someone takes a sizable demotion is A, they want more volatility. Very few people express it that way, but I applaud you for expressing it that way. But they believe in something that's greater in the future. Of course, they believe that they'll eventually make more money. But everyone who joined me and who joined Alex and who joined Ken in his early stages probably walked away from something safer to do something riskier. And so I think the why is enormously important, and it's very rarely talked about in our industry. I mean, our industry, you know, I think part of the challenge is that in most industries, you have periods of calm to build the foundation. In our industry, you don't have any calm. So if you're in the middle of a war, and I mean like a legitimate war, you're not thinking about, let's build the next civic center right now. You know, all you're thinking about is, what do I do to survive? What do I do for the next day? What do I do for the next week? I just got to get to the next week. We have to survive. You think about short-term strategy, short-term tactics. And I think part of the challenge of the hedge fund industry is that because we're judged so on such short-term bases, you know, daily, weekly, monthly, and because people are right 55% of the time if they're spectacular, that there's an existential fear, I'm not going to be here in a quarter. I'm not going to be here in a year. And so you don't have many people who think about foundation building. And I think one of the challenges, which was, you know, when you asked the original question about multi-managers versus single manager funds, there's no doubt that a multi-manager platform is a better business from a durability perspective. If Alex or I get hit by a bus, we're shut down tomorrow. I don't know about Ken, but hopefully Citadel can survive. And I think from a business perspective, that's what people often think from the value of a multi-manager platform. But my controversial response to that is, so I worked at 3 multi-manager platforms for my entire career before I set out to launch Tourbillon, and I intentionally chose not to do it. And I think part of the reason is that, and you know, I think Ken hit on this with his top 10%, is that most people aren't actually that good. And a lot of people haven't learned the lessons the hard way. And many lessons, unfortunately, can't be taught unless you learn them the hard way. And I don't want someone younger or newer learning the same lessons that I made 10 years ago or the same errors that I made 10 years ago on my money, on someone else's money. I want my investors to know who's managing their money. And the challenge with a multi-manager is that you don't ultimately know who's managing your money. And for me, I think the bridge, which is kind of why I think the topic of this presentation or this panel is appropriate, is that I think it's somewhere in the middle where you want people to incubate for many, many years where the consequence of error is small. You don't want someone learning a very hard lesson on a lot of dollars. But you do want them making lots of small mistakes as they're moving up. And so I think one of the challenges is how do you bridge having investors give you the time to train people as assets so that you can profit from that ultimate optionality? How do you balance that where ultimately they do become decision makers, they do become trigger pullers? I of course know that I can't do this for 30 years at the same level that I'm doing it today. And there's somewhere in the middle where you have to bridge a long incubation of training with ultimately taking over the reins. And I think that's really the challenge of how we kind of get from what the 1990s hedge fund is to what Ken has done.
I think it's actually a selling point. There are certain funds that are, where very talented people have left and started very successful funds post. And it's seen as, those funds are seen as great, use the word incubation, but basically great places to make mistakes, learn and grow, and then they go out and they are some of the most successful launches that we've seen in the last few years, and they come from key man funds. So I do think there's something to that. Gideon, what is your perspective as an allocator?
Yeah, I don't think there's a right answer. I mean, it's interesting listening to you, Jason. Of course, all the people who decided to give you money could have given it to someone with 20 or 30 years greater tenure, already running, $15 billion, who's done phenomenally over a long period of time. And I think your point of always wanting to have your money in the safest hands possible, if that were the reality, I think it would be hard for anyone to ever start a new business. I think there's tremendous merit, actually, to the platform business. Granted, none of the individuals are as good as you might be able to find on a one-off basis, but I think the difference between the 60% hit rate and the 52% hit rate is right there. I mean, no one minds the casino business, but they only win 51% of the time, and it's actually a great business if you can have a lot of bets on and be right 51% of the time, and they're relatively uncorrelated bets, and that's really what the platform business ultimately ends up being. But I also think it has a lot to do with ambitions. I mean, if your ambition is to build an institution that can withstand the retirement of the founder or the hit by the bus, then that has a certain set of implications, and I think it requires a diversification of risk takers and a diversification of risks. If your ambition is to build the best investment organization you possibly can and put up the best returns, then you're going to want to have a level of ownership for it and be less concerned about asset raising. So I don't think there's a right answer here, I guess, should answer.
All right, we have time for one last question, which
Yeah.
I'd love all of your perspective on. So hedge funds are often accused of underperforming benchmarks, being too short-term oriented, and being too correlated to each other. But how much of this behavior is actually the result of, not to make you the bad guy, but is the result of institutional clients' expectations of being unwilling to accept longer-term volatility?
All of it.
Okay.
I mean, you've seen a complete sea change from the 90s when when it was mostly high net worth and foundations and endowments and a willingness to take risk, and it's become an institutional business where there are many more careers at risk. So there are people, trying to ensure that they don't have any investments that they recommended that lost money, and you have institutions that have costs of capital or liabilities that require them to make much lower levels of return, and they have a much lower risk appetite. And so I think that, like any other industry, the supply responds to the demand, and if the demand is for lower volatility products, that's what the buyers ultimately get. So I think that's absolutely a reality.
I know we're running out of time, just to make one quick question. I also think it's not only the clients, I think managers too. When you become successful, it can lead to incremental thinking, small thinking, and that can be dangerous too.
Well,
successful companies, successful funds get large, and once you get large, you build systems and processes that reinforce this idea that the world will sort of stay the same way. You want to protect the good thing that you have going, and the reality is that the world's constantly changing. So you have to be open-minded about breaking down the way that you approach the way you do
And I think investors, in the pursuit of alignment of interest, have asked hedge fund managers to put the vast majority of their liquid net worth or their net worth in the hedge fund.
Exactly.
I think that impacts risk appetite. From an investor's perspective, this is just one line item in my portfolio. I wish they took a lot of risk, but you've told the hedge fund manager to put all their money there and their reputation on their line, and it's their livelihood. And so I think there's an inherent issue there.
Ken?
All right, so I would say both are right. Both are right. And I would say that there's one area I disagree. We had that near-death experience at Citadel in 2008. We lost about half of our capital in 16 weeks. And yet, almost every one of our institutional clients stood by us in 2009, 2010. If you've had a track record of success, if you can clearly communicate both why things went wrong and why you're going to put things back on track, you can maintain the conviction of your stakeholders. And so I wouldn't sell the institutional investing community short. They're not short-sighted. They make thoughtful, long-term decisions. We are in a business where every day matters, every month matters, every year matters. But I would say that if I look across the stakeholders at Citadel today, the degree of sophistication with which they look at their investment in our firm and other firms has increased dramatically over the last 20 years. It's increased dramatically.
I think it's just about transparency and communicating what your goal is. I think, you know, Ken made a point earlier, and I'll keep it short because we're getting it's gotten much more crowded. I mean, it's the reality. There's many more players, and I think the challenge is that businesses are still growing and businesses are still shrinking and many businesses are still going away. So the business opportunity is still there, but I think the game that we knew in the 90s has changed, and I think investors and allocators have to recognize that patience is more rewarded now than it used to be. Volatility is more rewarded than it used to be. I believe you have to take more volatility because there's so many people who need to show good monthly returns. And I think it's just about education. And I think I agree with Ken, I think the investor community is very sophisticated, but I think you just have to articulate what you're trying to accomplish. And if investors are more aware that how different the industry has in fact changed and evolved, that there's spectacular opportunity.
Thank you. Thank you, everybody. It's one thing to talk about the market and the economy. It's another thing to talk about your organization and who you are. So thank you.